Our next guest is the largest institutional investor in CoreWeave. He is David Snyderman, Senior Managing Partner at Magnetar. Nice to have you here.
Well, thank you so much for having me.
And a great day to have you as well. Obviously, you got involved with this company some time ago. My understanding is, David, is that you, in fact, were also involved in the pivot from being a Bitcoin miner to obviously what we know today as this company. What gives you the confidence overall that that this is going to be a success? Obviously, it's going to be a success for you guys, given where you invested so long ago. But more broadly speaking, for those who invest today.
Well, first, this is a really exciting day for Magnetar, for our investors, and especially for our partners at CoreWeave. Maybe I should say Magnetar, we approach investing through a debt investor's lens. And so that means we're very focused on the assets, the cash flows, and downside scenarios. And that's what originally drew us to CoreWeave. And they're picks and shovels. They're the infrastructure for AI, right? And so if you think about their product today, it's the essential product to make AI go. And so they are purpose-built for high-performance compute for AI workloads. And when you ask, why are we so confident today, we read all the same headlines that everyone else reads, that things are slowing down. But in this parlance, we see the order book. And, this is our 20-year anniversary at Magnetar this year. So this is the most demand we've ever seen in a company. They can't keep up with demand. And so for us, we're extremely confident that this will continue.
Yeah, and the CEO of the company obviously saying similar things this morning on Squawk Box. You mentioned, of course, your approach from the fixed income side. You are a large creditor to the company.
Yeah.
Can we talk about this a bit? I mean, are some of your loans are backed by the actual value of the GPUs? Is that correct?
That's correct. So all of our loans are. And so I think that's a misconception in the marketplace. People keep focusing on the debt of the company. But for us, we're so used to working in capital-intensive industries, where Magnetar is at its best is where we can help companies lower their cost of capital. So take a simple example. If you have an airplane manufacturer and the government gives you an order for an airplane and they're going to pay you $100 and it costs $50 to build it, you take that contract to the bank. You say, I need to borrow $50. They put the contract against it. When you deliver, you pay back the loan. This is the same thing we did with GPUs. We took some of the best credits in the world, so Microsoft's in the news a lot to be a big customer.
Yep.
We took a Microsoft long-term contract to essentially the bank, to the markets, and said, how can we finance this contract? So I think the key point that people haven't really understood so far, at least from what we've seen in the coverage, is that each one of those cash flows, the loan is it's exactly matched by cash flows.
Right. Okay. So, and over the time of the actual contract, I guess, as well.
Correct.
But the concern has been among some investors the depreciation schedule. You have Jensen Huang last week saying Hopper's going to be worthless, basically. Now, he kind of walked it back a little bit. But, people wonder whether they have to come up with more collateral if, in fact, you're going to be depreciating the value of these GPUs more quickly, because 2 years from now, they're not worth anything.
Yeah, so that's not how these contracts work, right? The way that's a misunderstanding, I think, in the marketplace.
Because the money's coming from Microsoft, so it doesn't matter.
The money's coming from Microsoft, and the way these work is it amortizes down quite quickly with the contract. So there's a depreciation schedule, and there's the amount of cash flow coming from the counterparty. The loan itself amortizes down each time they pay, so you can never get in the situation where you don't have enough collateral for the loan.
What is the average life of the contracts, typically?
I think they just reported in the S1, it's a little over 4 years.
And are your expectations that Microsoft will be there in 27 and 28, particularly given their 62% of revenues, at least as of last year, I believe it was?
Yes.
And, there have been many reports about them pulling back in certain areas.
Sure. I think that's a better question for CoreWeave themselves. I think what we're seeing is just customer demand in general. And so if you think about starting with the hyperscaler demand and going to more corporate demand builds over time. They build products, they get used to those products, and they grow and they grow and they grow. We're just seeing that. We're seeing that growth.
What's the competitive mode here, though?
So it's funny. Everyone talks about reliability, and reliability and skill is the competitive moat. But I don't think a lot of people put any substance around saying reliability. So I'll give you a quick example. When you go to train a model, you save, you train for 20 minutes, and you save again. If at any time in that 20-minute span it fails or breaks, you go back. Compute's really expensive, but that's not the most expensive piece. The most expensive piece is the compounding effect of not getting your product out to market. CoreWeave and their management team, they are the best at having reliable, large clusters in the marketplace. We've been investors for 4 years now. We know they're the gold standard. I think what this IPO does is it brings it to the marketplace so people have the chance to really understand the company's story.